You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you still in quarantine from Santa Barbara, California. Before we start, I want to remind you of a few things. There is a website called wealthformula.com. It is the home base of this podcast, and there's lots of resources there for you to take advantage of. It's also where you're going to sign up for our accredited investor club if you are an accredited investor. Now, what is an accredited investor? It's somebody who makes $200,000 per year or $300,000 if filing jointly, has done so for 2 years, or you have a net worth of $1 million outside of your personal residence. So the bar is not that hard for most of you, I know, because you're super successful. But you don't have to apply for something to be accredited. You either are or you aren't. And if you are, you qualify for magic, right? Opportunities to create wealth in probably more efficient and tax-efficient ways as well. So go check that out, Investor Club at wealthformula.com. Now, as for today's show, and it's probably going to be a lot more than just today's show, let me explain what happened. You see, we had episode 200 not too long ago. It was a few weeks ago. And so I had all of these questions on, Ask Buck, and it was going to be like episode 200. And I was like, okay. So I had all these questions, and I was going to do multiple shows in a row to answer these kind of questions. They tend to be pretty popular shows, but the problem was, not the problem, but what ended up happening is we got hit with this whole COVID-19 thing, and we ended up doing a series of shows that were much more relevant to that, what was going on. We've had economists talk about what's going on. We've had we've had doctors, physicians come on the show and discuss things. Anyway, we kind of got behind with all these questions, but I have all these questions, and again, they tend to be very popular shows because I think, these are the shows where you get my opinion. It's not just me interviewing somebody else. So today we are going to start with these questions, and I have to warn you, some of them are a little bit old, and we're going to get through them. And my guess is it's going to take a couple of shows. It might even take a third show. Who knows? But we're going to start. We're going to get through pretty much everything that you have sent me. So we'll get started with another episode of Ask Buck when we come back. Okay, welcome back to the show, everyone. As you know, there is no guest today. There is only me, and there is you and your questions. So with that said, let's move on right away. Let's get started. And the first question is an audio question because we have both audio questions. And for those of you who are a little shy, we have ones that were written, which I will read as well. The first one is from Bruce. Here we go.
Hello, Buck. I am a primary care physician working in the suburbs of Chicago. Over 30 years of practice, I have regularly invested in the stock market. However, over the past 5 years, in an effort to diversify away from what I perceive as an overvalued and volatile asset class, I've moved away from Wall Street and now have a significant portion of my portfolio in cash. I recently invested in an oil and gas offering with Resolute Capital Partners in an effort to take advantage of recent price declines in that asset class. What other opportunities for investment do you see presenting over the next couple of years? Thanks, Bruce Corwin.
Well, thanks for your question, Bruce. I have to say that being in cash right now is obviously fortuitous. I can't remember if this particular question was before COVID-19 or not, but if it was before, Well, great place to be in right now, in my humble opinion, that is cash. Cash is king. And as I've said on this program before, this pandemic has hit us like a gigantic earthquake. But, as we saw in Fukushima, Japan, after they had the big earthquake, the ensuing tsunami was even worse and more destructive. And the complexity of trouble from that initial insult of that earthquake, including the nuclear reactor failure, etc., was a complete surprise. And, that was not predicted by anyone. So using that horrible example of, what can happen when you least expect it after you get punched in the face, we're waiting, in my opinion, right now for a tsunami to hit. I'm not sure it's going to hit. To be clear, it's completely unclear what's going to happen to me, but it's certainly possible. And what would prevent that tsunami from hitting? Well, we have unparalleled fiscal and monetary policy measures being taken right now that are essentially thwarting a depression that would almost be guaranteed. If the government and the Fed weren't doing what they were doing right now, we'd all be screwed for sure. But the real question is, how much of what they're doing right now? I mean, all the trillions of dollars and all of the, the Feds even get involved in junk bonds and all that. How much of it, those efforts are going to mitigate our damage? The stock market is obviously betting that things will get back to normal pretty quickly. They seem to be very, very optimistic. You've got a market that's down maybe 12 to 14%. And you have to ask yourself this question: is this a 12 to 14% problem? I don't think so. I think it's a far greater problem than that. So the market is clearly factoring in this idea that there's going to be some sort of quick recovery. I've talked to some institutional advisors, and they are like, oh, yeah, we think that the worst is behind us. I'll tell you what, it's hard for me to believe. But then again, we've never had to do this kind of, fiscal and monetary relief this quickly and this fast. So, I'm not as optimistic as some of those people, but I'm also admittedly not smart enough to know if these interventions by the government and the Fed will give us some sort of soft landing. I would be shocked. I would be very surprised. But I also am not going to sit there and act like I'm, that I can predict the future. We've never been here before. But, getting back to your question, bottom line is that most asset classes are still in a falling knife scenario. The old saying that never try to catch a falling knife. If things go south, everything will go on sale. But it's hard to say, right? It's hard to say for sure. As you know, as our listeners and our investor club knows, we in multifamily, in apartment buildings, a working class multifamily in markets like Dallas and Phoenix, Scottsdale, and Atlanta, where we focus on high growth markets and value add, we're actually doing really, really well. I mean, it's pretty extraordinary how well we're doing throughout this. And what I am realizing is that responsible operators, like the good jockeys, that if you bet on the right jockeys, they are showing resilience of this asset class right now. Sure, there's bad operators that are using this as an example or using this as an excuse to say why they're not performing. But the good operators are really performing well. And if that trend continues, it is quite possible that we could see multifamily apartment buildings, all these assets in real estate that are performing well despite all of this craziness, actually turn into like a safe harbor for a lot of bigger money, and we could see a lot more money then going into apartments and drive up costs. So it's hard to predict, but overall, what I would say is it's a falling knife. In my opinion, you don't do anything, except I don't disagree at all with your oil investment. It makes sense to me because of what happened with oil and gas. We started out with obviously this enormous drop in energy consumption. Energy consumption dropped because, well, hey, we all are home, right? And no one's traveling and all that stuff. But then on top of that, there was this breakup between OPEC and Russia, the so-called OPEC Plus, that caused prices to plunge even more. And as you know, crude oil prices actually dropped below zero. So, oil and gas doesn't really get beat up any more than that. You're already negative, right? How much worse could it be? So I actually think that blood was in the street, and as we're seeing, there's already a little bit of a recovery there. And frankly, if you look at oil and gas as we get out of quarantine, there is this natural rise in demand just because we're going to actually be using oil and gas. So as long as we, a year from now, we're sitting there and we're driving cars and we're on planes again in a year or two from now, then the horizon seems to be fairly positive. Anyway, bottom line is, with everything else other than oil and gas, I think my opinion is wait and see, and it may be Q4, it may be late summer, something like that. And if you're sitting on cash, you can buy anything that goes on sale. That's a great place to be. The next question is from Dave Clivens. Dave, this is a written question. He writes, which nations or municipalities have the best bargains on farmland? That's one question. The next question is, what is the best way to cash flow raw land? And then the final question, when will the 37th parallel open, and how do you connect with South Koreans who will be developing businesses there? Wow. Well, I'm not great at Trivial Pursuit, Dave. I'm just kidding about that. I'm probably okay at it. But what I am not is I'm not an expert on farmland. I'm not an expert on raw land or Korea. I would add that I wouldn't trust anyone who claimed to be an expert and gave you advices in all these areas. Now, what I will tell you is this. When it comes to farmland, I wouldn't get into it unless you have a farming background, right? Or you know someone who you really know and like and trust and has a great track record in farming to go in that direction, right? I mean, it sounds really appealing. I agree with you. Farmland, hey, I'm all about it, right? But I don't know. I don't know anything about farming, and I don't know a lot of, farming entrepreneurs that I know, like, and trust, and that I think are really smart people. I'm sure they're out there, and if I knew who they were, maybe I'd be investing them. But I don't know that. And you have to focus on not only the asset class, but who you know who has expertise there. The other thing about farming is I would quite honestly trust virtually no one on the topic of farming in the podcast ecosystem, especially if you start hearing about anything, offshore. I mean, run the other way if you start hearing about offshore farming and stuff, okay? Just run the other way, because in my experience, a lot of this stuff, particularly on the in the podcast ecosystem, is that offshore means for investors, well, if you are getting screwed or cheated, or you feel like someone has broken the law, well, you're shit out of luck. Try to get the SEC involved in the Caribbean. Good luck with that. So bottom line is, folks, keep it boring. All right. And with regard to raw land, which, it's a different thing, because we're talking about something domestic now, maybe something that I know some people have had some experience, some luck with this idea of cash flowing raw land. I know the Land Geek talks about that, and he's been on the show. But I do know a number of people who've done this, and the one thing that it is not is passive income. It requires a fair amount of work, and it is also not something that is particularly scalable. And from an investment standpoint, I like scalable, right? I like something that really doesn't have, I don't have to spend a certain amount of time doing it, and then I kind of cap out and I can't really do more than that. But, that said, if you don't mind giving yourself another job, you're looking for something fun to do, and maybe you get a little extra side gig income, so to speak, maybe check that stuff out. But, the bottom line is, don't expect it to be easy or without significant growth limitations. Farming and raw land are businesses. They are not passive assets. And I think sometimes, again, in this real estate podcast ecosystem, there is this tendency to make them seem similar, and they are not. They just are not. And you should be getting substantially higher returns than anything that is a business and requires a lot of people, personnel, and more than just people just needing to live someplace. As for Korea, well, those kinds of large macro movements do, in fact, they obviously create huge earning opportunities. Who knows when, if there's really a North Korea opportunity coming in. But they'll likely come from, the people who are going to get rich off of this are probably going to be in the area of private equity who already understand Asia extremely well, which, again, I do not. Bottom line is, I think that all of this stuff you bring up is great, but remember that sometimes boring is good. Let me give you an example of this, right? Because I've been through this. Every entrepreneur likes to chase shiny objects until they realize that, you know what? There's some things that work and some things that don't, and you stick with the things that do. So before COVID-19, I'm giving an example here. Literally on this show, I wrote, I talked about how I was tempted to get involved with these new endeavors, right? I wrote about this and I talked about this. There was some opportunities in commercial real estate. There was, commercial real estate with large, tenants, that seemed very stable. There was some opportunities that sounded really good with some extremely good operators in the fast food industry. And I seriously thought about them, had some meetings, but then I turned them down. And I turned them around. I turned them down just a couple of months before all of this COVID-19 stuff happened. It wasn't because I'm claiming to predict this. I didn't. The bottom line was that when I looked at those opportunities, the risk-adjusted returns for those investments, that's the important line, was not even close to what we get in apartment buildings, what we've been targeting and what we've gotten in apartment buildings through our investor club. Just an example, Western Wealth Capital is one of our main partners. They've done 30% annualized returns on average of 32 divestments, 30% annualized returns on multifamily workforce, multifamily working class real estate. I mean, that's a lot more stable than, a burger joint or, office space, a lot more stable. So you got to show me some serious, some serious returns and risk adjustment for me to start looking in another direction. Anyway, like I said, so I passed on that. Guess what? 3 months into the disaster, all those businesses, opportunities that I was thinking about, well, they're toast, right? I mean, they may recover, but they're toast right now. But our multifamily real estate, we've got in our investor club $350-400 million of investment, multifamily real estate. And collectively, we not only kept cash flowing in the last few months through this crisis, but we also actually hit all-time highs in occupancy, right? Because people got to live somewhere. So the moral of the story, sometimes it's better not to chase shiny objects. Sometimes boring is good. Actually, most of the time, boring is good. Next question is another written question from Michael Carter. It says, "Hi, Buck. I've been enjoying your show for the past couple of years. I'm early in my medical career, and I'd like to get your thoughts on what you might do with, let's say, $100,000 during this pandemic. If you put yourself back in your shoes when you weren't yet a high net worth individual but had a sizable W-2 income and this pandemic fire sale came along, what asset classes would appeal the most to you under the current conditions? And would you buy now or wait a few months for things to become clear?" Well, remember, don't try to catch a falling knife, right? That's what I'll start with. But let me start by also saying that Nothing that I tell you is advice. This is all my opinion. I am not a certified financial advisor who, for some reason, people think has information that is actually valuable. But what I will tell you is that what I would do if what I know now, if I knew that 12 years ago, say when I first got out of training. And in reality, what I would do then is what I do now. Was slightly different, but it's basically the same formula for what I do now. Because again, going back to the last questions, I kind of stopped chasing shiny objects, right? So now 85 to 90% of my investable assets every year go into either wealth formula banking, a type of infinite banking that you know about when you go to wealthformulabanking.com, or real estate, or sort of both, which we'll get into in a second. Specifically in real estate, I like multifamily workforce housing, as we discussed, and I also occasionally will dip my toes into the self-storage space as well. Now, again, with regard to real estate, to be honest, there, everybody goes through this discovery of real estate. Maybe you read a Kiyosaki book or something like that, and all of a sudden you're like, I like this real estate thing. It makes a lot of sense to me. But what you have to do is be honest with yourself, and being honest with yourself early on is a good idea. And ask yourself the question of whether you want to be a landlord or if you want the income and tax benefits of real estate and all those great things, wealth creation, etc., without giving yourself another job. Now, if you don't want to be a landlord, focus on identifying operators with whom you can invest. I've talked about a couple, and we deal with a lot of those people in Investor Club for accredited investors. So you can go sign up for that if you're interested. But it's not just our group. I mean, MC Companies, Ken McElroy's company, I love them too. Focus on identifying operators with whom you can invest over and over again. The good operators will get you consistent returns that will often exceed anything you could do on your own without the liability because you're a limited partner or the work. Well, how do you do that? Well, if you're an accredited investor, it's going to take a little work up front, right? Your due diligence becomes not doing due diligence on properties, but actually on the operators, right? Choosing the jockeys. And once you find the jockeys, you can keep going back to them over a long period of time. That's what we do in our accredited investor group all the time, right? Now, the other thing I mentioned is wealth formula banking. This is also known as infinite banking or cash flow banking. It's a strategy that, it's derived from whole life insurance. And of course, if you are a newbie and you just got out of training, you heard a lot of bad advice and misinformation on permanent life insurance. I heard the same thing, and I couldn't figure out why all of a sudden all these super wealthy people around me were using permanent life insurance products when these people that, who seemed like they were really smart when I came out of residency told me that it was worthless. Well, it's because they weren't super wealthy. They didn't really know what all these different paradigms and strategies look like. Bottom line is, strategy like wealth formula banking allows you to, you make 5.5% free, tax-free compounding interest that's virtually guaranteed. We can say virtually guaranteed because dividends have been paying out since before the Civil War. And through that time, a bunch of banks have gone, defunct. You went through the Great Depression, hyperinflation, et cetera, and dividends kept paying out in these kinds of strong companies. 5.5% tax-free compounding interest. And then that's not bad, but what I can do is I can borrow money from the insurance company collateralized by the cash values that I have and borrow that money for simple interest, right? So my money's growing at a compound interest. I'm borrowing money at a simple interest from the insurance company. Meanwhile, while I use that simple interest money to invest somewhere else, my money continues to grow at a compound interest in my cash value account. That is what I call double dipping, investing the same money in two places at the same time. The younger you start in this kind of thing, the healthier you are when you start this kind of thing, the more powerful it can become. And I don't know anybody who uses this, who started doing this, who regrets it. So check out wealthformulabanking.com to learn about it. Now, this strategy also has two additional benefits, right? First of all, it's stable as anything gets. Far more conservative than corporate bonds, in my opinion, right? I mean, insurance companies that own all the fanciest real estate in the country and all of the, finest assets and are massively capitalized, been around for hundreds of years through all of these things. This is, in my opinion, going to be superior to a corporate bond. The second benefit that is often overlooked paradoxically in these strategies is this is permanent life insurance, so there is a death benefit. In other words, seems obvious if you think about it this way, but you can screw up your finances as bad as you want, while you're living, but the fortunate thing is for your children that you have created permanent insurance. In other words, you could die at 120 years old and you will guarantee your children won't pay for your investing mistakes. They'll be taken care of. Now, given where we are at in this moment with this pandemic, as you asked about specifically, not buying any assets for a while until the economy declares itself with either a surprising rebound or blood in the street. The knife is falling, right? I would personally, right now, potentially look into setting up a banking policy. Go to wealthformulabanking.com, look at it. May not be for you, but I'm telling you, the sooner you get this concept in your head and you learn the power of it, you owe it to yourself to do that. Now, I said 85 to 90% of my money goes, either the permanent products or real estate. So you might be wondering where the last 10 to 15% of my portfolio goes. Well, I like to take some chances and look for asymmetric risk opportunities that could create disproportionate returns. So we're talking about startups, venture. For me, I played with cryptocurrency. I'm not sure, honestly, if that's a great idea for you until, you have a little bit more of a foundation. But as you start to build your wealth and you have some more money to play with, I have called this in the past Maserati money until I actually bought one. So let me call it Ferrari money, or Porsche money, the money that instead of buying a Porsche or Ferrari, you decide, I'm going to play with this, and if I bought one of those cars off the lot, it would depreciate automatically, and there's guaranteed no return. Here, I'm going to play with something and give myself an opportunity for an enormous return. Anyway, let's see. I would say that perhaps that is a good place to stop for this particular episode of Wealth Formula Podcast, at least, with the Ask Buck component of this. We'll be right back after these messages. Welcome back to the show, everyone. I want to remind you that if you like this stuff and you're really into, this whole concept of personal finance, and you want to find a like-minded group, and you've got some time in your hands because of the pandemic or whatever, you may want to consider joining our Wealth Formula Network. This is our private group. Wealth Formula Network is the sort of our private community online, right? So it starts with a course, then you have a Facebook group, then you have, there's a private portal, and then probably the most popular thing is bi-weekly Zoom video phone calls. They're not just phone calls, they're obviously video conferences. I think that's what you would call them. And we do that bi-weekly. We do fun things like, for example, this week we are doing a book club on the Black Swan, which the Nassim Taleb book. We'll talk about everybody's personal, financial questions, address them, This is where we can, name names and take no prisoners, so to speak. If there's things going on in the space and you need to avoid somebody, this is where we will freely talk about it. But again, it starts with a course. You go and then you become part of the community. It's definitely something to look into. If you are one of those people who loves this stuff and nobody around you does, your wife won't talk to you about it, your neighbors, they're not interested, and you need an outlet, right? So this is a community for you. Check it out. Go to wealthformularoadmap.com. That's it for this episode of Ask Buck and Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.